Ladies and gentlemen, when you look carefully at the patterns that shape financial history, one thing becomes obvious. Markets don't collapse because of sudden shocks. They collapse because imbalances were ignored for too long. And what we're seeing in silver right now is exactly that. A pressure that has been silently building for years has finally reached the point where it can no longer be contained. Isn't just a price move. It's not just volatility. It's the beginning of a structural shift, a shift from an artificial market built on leverage and paper claims to a market driven by real physical scarcity. Most people call it a collapse, but anyone who understands long-term cycles knows is what happens when reality catches up to a system that has been pretending for too long. Cycles are the most reliable guide we have for understanding what is happening in the silver market today. When you've seen enough long-term cycles, you stop reacting to the noise and start recognizing patterns. You begin to realize that nothing in markets happens in isolation and nothing happens without a cause. What looks like sudden collapse is almost always the result of pressures that were building for years beneath the surface. And those pressures don't disappear. They simply wait for the right moment to express themselves. The situation unfolding in silver right now is not a surprise to anyone who pays attention to how cycles work. Markets move from periods of equilibrium to periods of imbalance, and eventually to periods of correction. These phases are as predictable as the changing of seasons. The only difference is that most people don't see them because they're focused on short-term movements instead of long-term forces. But long-term forces always win. They shape the environment in ways that no announcement, no manipulation, and no short-term intervention can prevent. For years, silver market has been managed under the assumption that excess supply, real or perceived, could keep prices artificially suppressed. Governments, financial institutions, and large market participants have relied on the belief that they could control this market indefinitely through paper contracts and leveraged positions. But cycles don't allow indefinite control. They allow temporary illusions. And illusions always come with consequences. The consequence of ignoring fundamentals is that you create a market where the price does not reflect reality. When a market spends too much time disconnected from reality, it becomes fragile. Fragility shows up quietly at first, slowing production, rising industrial demand, delayed deliveries, thinning inventories. These are like tremors before an earthquake. People who understand cycles pay attention to these tremors. People who don't dismiss them as noise. But tremors always mean something deeper is changing. In silver's case, the cycle has advanced into a point where the imbalance between physical supply and paper demand has become impossible to hide. That imbalance didn't appear overnight. It has been building for decades as industrial use of silver expanded, as production costs rose, and as new technologies increased consumption at a pace the market wasn't prepared for. This growing gap was covered by the expansion of paper instruments, contracts that promised silver that didn't physically exist. As long as confidence remained, the system appeared stable, but stability based on confidence rather than fundamentals is temporary by nature. Every cycle has a trigger, not because the trigger itself is powerful, but because it touches a system already under strain. Once confidence begins to slip, the cycle shifts quickly. People start questioning whether the contracts they hold represent anything real. They begin to wonder whether the supply they were promised can actually be delivered. Doubt spreads through the system. And with it, the illusion of stability collapses. That collapse isn't a failure of silver. It is a failure of the structure built around it. The consequence of prolonged imbalance is always correction, and corrections are rarely gentle. When a market has been mispriced for too long, the adjustment tends to overshoot as participants rush to reposition themselves. This is why collapses often look dramatic. But drama is only the surface. Underneath it, a simple principle is playing out. Markets always return to fundamentals. They may take detours. They may delay the inevitable, but they never escape it. Cycles are not moral. They don't reward or punish. They simply restore balance. And restoring balance is often uncomfortable because it forces everyone to confront truths that were easier to ignore during the illusionary phase. The truth in silver is that physical scarcity matters. Industrial necessity matters. Real supply and real demand matter. For years, these truths were overshadowed by leveraged instruments and artificial pricing mechanisms. Now, those mechanisms are breaking, and the cycle is forcing the market to reconnect with reality. The important thing to understand is that consequences are not random. They are the natural result of actions taken earlier in the cycle. When silver was undervalued and oversold, the consequence was reduced exploration, reduced production, and underinvestment in mining. When demand surged and inventories tightened, consequence was pressure on the supply chain. When paper claims multiplied beyond physical capacity, the consequence was systemic fragility. Now, those consequences are arriving at the same time, creating what appears to be a collapse, but is, in fact, the cycle completing its natural course. This moment isn't surprising. It's inevitable. And the people who understand cycles recognize that what comes next is not chaos. It is the clearing of imbalances, the removal of distortions, and the realignment of price with truth. That alignment is never comfortable, but it is always necessary. When you strip away speculation, leverage, and narratives, every market eventually comes back to one simple force: the relationship between supply and demand. And the silver market today is undergoing a transition that becomes obvious the moment you examine these fundamentals without bias. Reality has a way of asserting itself, especially when it has been ignored for too long. And what we're witnessing now is reality rising to the surface. For years, the perception of silver has been shaped more by financial engineering than by the metal's actual physical availability. Paper markets created the illusion of abundance. Contracts were issued, traded, and multiplied far beyond the amount of physical silver in existence. As long as confidence remained intact, these paper claims functioned as if they represented real metal. But confidence isn't the same as supply. And eventually, the divergence between what people believe exists and what actually exists becomes impossible to maintain. The core issue is simple. What as the world has been consuming silver at a rate that far exceeds new production, and it has been doing so for a long time. Unlike many commodities, silver is not just a store of value or an investment instrument. It is a critical industrial metal used in everything from electronics and solar panels to medicine, batteries, and high-tech manufacturing. Modern economies rely on it so deeply that removing it from even one major industry would cause operational paralysis. Physical supply has not kept pace with this growing dependency. Mines are not producing enough silver to meet current demand, let alone future demand. The ore grades are declining, extraction costs are rising, and new discoveries are becoming rarer. Mining companies are dealing with tighter margins, geopolitical challenges, and environmental regulations that